Good afternoon, everybody. My name is Russell Munn, and I'm one of the financial advisors here at Hermitage Wealth Management. Thank you, everybody, for tuning in for our Q3 2025 quarterly market review. And I'm very excited to have Mark Gleason, who's going to be joining us from Alliance Bernstein. Just a little bit of background on Mark. He is Vice President, Managing Director, and Head of America's Multi-Asset Business Development Team, where he's broadly responsible for portfolio strategy and communications. He joined Alliance Bernstein in 2009, and previously he was the director on the multi-asset team with an explicit focus on the group's alternative and risk managed solutions. Before that, he served as a multi-asset product specialist and as a regional consultant in the U.S. retail group. Mark holds a BBA in business economics from Loyola University, Maryland, and is a CFA charter holder. And I have to say, Mark, that's quite a mouthful and an impressive bio there. So I want to thank you very much for joining us this afternoon.
Well, I appreciate you having me and looking forward to spending some time talking about the current backdrop.
Yeah, us too, actually. And again, that's a really good segue into hopefully what you're going to tell us about today, because obviously it's been a crazy three-fourths of the year, right? I mean, a lot of topics and a lot of things that have been going on, I think, throughout this year, at least that we're talking with our clients. So we're excited to, hear a little bit more about what Alliance Bernstein thinks. And, as we kind of head into the final quarter here, right? We're sitting here on September 24th. What can we expect?
Absolutely. Well, happy to dive in. And yes, it has been interesting times, if nothing else. And I think one of the things that we've all been living with and hearing about and reading and seeing all day, every day is tariff news, right? So let's jump right into it. I'm not going to bore or punish the broad group by actually going through every box on this page, but the point of this is to display basically in the first 6 months of the year all the material news we had around tariffs on any given month. And there's two broad takeaways, which is one, just the sheer volume of news that we had and markets had and clients had to digest throughout just the first 6 months of the year. The other thing that I'll point to is that we're sort of broadly color coding here, where red can be viewed as more market unfriendly and green more positive from a market backdrop. You also saw a broad trend that has frankly continued of a very sort of red heavy first quarter of the year, moving into a bit more of a mixed bag or even more sort of a green skewed market backdrop from a tariff perspective as we entered the second quarter of the year. And that was perhaps unsurprisingly felt by capital markets and asset returns more broadly. So you had on the very left side of this display in the bar charts, what was, at least for recent history, a relatively muted first half for US markets in particular. Obviously, international and EM have been the big winners year to date. We can talk more about that as we move on. But what you really saw was on the far right, basically the huge delineation between kind of pre and post Liberation Day and the market digesting and moving through all this various news flow around tariffs. As we sit here today, right, when we did this, US large cap was up about 6.2 through the end of June. We're right around 13% as we sort of talk on September 24th. So has moved up another 6% or so in the third quarter. So that performance has really continued to run again as the market started to digest and get a little bit more certainty around tariff news more broadly. Credit has been sort of your steady Eddie, pretty consistent, even around sort of the dislocation around the tariffs and the news flow, where credit markets have been very well behaved. The quality there has continued to be very strong, even with what I think everyone would agree are reasonably tight spreads. Those markets have continued to be very well behaved and generate pretty consistent returns. And then kind of conversely, government bonds have been a bit more all over the map, right? You've seen a lot more volatility on yield curve moves in government debt specifically. So where you took your government bond debt, the position on the yield curve, all of those were incredibly important for generating returns and could explain a huge amount of the variety we've seen in government bonds, which is pretty unique, right? Most, there's an old saying that a day's worth of volatility is a year's worth of volatility in the bond market. That hasn't really been the case now for 3 or 4 years, and we've continued to see that moving forward. And we'll talk a bit more about what our expectations are for yields moving and sort of the end of the year. But the other sort of then big thing that we've been talking about, and all of us have been talking about, one has been tariffs, and two has almost certainly been the Fed. And so when we think about and talk about with clients where we think the Fed is going and what our Fed watchers are seeing and hearing and going through all of the Fed press releases word by word and taking subtle tonal changes, and he used this word as opposed to that word. I think it's sometimes helpful to take a step back and sort of remind ourselves, okay, what is the Fed's mandate and what is the Fed caring the most about from just a high level perspective? And let's focus our research and our thoughts and where we think the market is going on those sort of three big buckets. So we've got them here, right? Inflation, growth, and the labor market. And we're actually showing this is based on Fed member respondents in terms of positive versus negative. So we're showing on those three big ideas what the sort of consensus Fed members' current point of view or current level of comfort is in these three big areas. So from an inflation perspective, they see more risk skewed to the upside, right? So they feel that in the balance of risk, the upside risk to inflation is elevated versus history. That's the opposite of growth, right? They see a weakening growth picture in the United States. And then again, on the labor side, they see risk to the upside risk or risk to a further deteriorating or slowing labor market. So all those taken together, a somewhat murky inflation point of view, but slowing growth and weakening labor, given the Fed's mandate, your expectation would be, well, we should probably be moving into a rate cutting cycle, which is obviously exactly what we saw last year. But related to what we started with, right, one of the big reasons why the Fed has been broadly on hold is because of some of the uncertainty around tariffs and specifically how those tariffs are going to impact inflation today and probably more importantly, moving forward. Because let's be clear, the tariffs have not really materially hit on inflation to this point, right? So we're showing on the left side of this display the two most common metrics of inflation, CPI and PCE. Both of those obviously crested in 22 and 23 and have been trending downwards more towards that 2% target for really much of the last 2 years. And when you look at it from a category perspective in the middle display, the trends that we've seen broadly have continued, right? And it helps to explain why tariffs to this point have not been massively inflationary, because the core driver of inflation has been really since some of the disruption around the Russian invasion of Ukraine in early 22 has been shelter, or more specifically core services, right? Shelter is embedded in core services and sort of the big four categories of inflation. Shelter prices remain elevated, in large part because on the right side of this page, they tend to lag pretty materially, which should make some intuitive sense, right? Home builders, home buyers, renters can't react to new information on any given day. There's leases, there's mortgages, there's lead times to build homes. So there tends to be about a 16-month or so lag that we think is appropriate to put on the CPI shelter. And when you look at that on the right-hand side, you can see, again, that's crested and has continued to fall and normalize as we've moved into the back half of this year. And again, just to give a little bit more detail on these four big categories, really food, energy, and goods have been reasonably well behaved since 2023, right? You can see, particularly on foods and goods, those spikes in 22 and 23, where you had disruption of wheat production and potential energy and all the knock-on effects to the conflict in Ukraine. But the aggregate contribution and the return to normalcy has been pretty quick, right? We haven't had material food or goods or energy inflation for really the last 12 months. And you can see we're displaying the last 12 months versus the previous 10 years. You're basically at or below those averages for those three big categories. The huge outsized impact and the laggard has been services, and again, more specifically shelter, where we're still running above the 12-month. The 12-month is still running above the 10-year average, but again, is moving in the right direction. So while you have seen some initial goods reacceleration, in part, we would argue because of the tariffs, it has not been large enough to overwhelm the normalizing of shelter prices. And another big reason why we think that tariffs are not currently impacting inflation in a large way is because these were relatively well-known and well-telegraphed from the administration, even pre-election, right? This was a big part of Trump's first administration, was increasing tariffs. It was a key part of his message when he was running for his third term, and that he's delivered on those promises, and the market broadly believed him. And so what you saw on the left display of this page is that, as you would expect, right, companies in the US who expected tariffs to move up in the back half of the year front-loaded purchases into the first half of the year. So you had a massive spike in the import rate up until March of this year. And then that has normalized as companies built up inventories with the expectation that it'll be cheaper to buy it in March of 25 than it will be to buy it in September of 2025. We will at some point exhaust those inventories, right? So that is a potential inflationary signal to keep an eye on, right? Once those inventories start to get drawn down and companies need to go out and buy new goods again, are the prices substantially higher, which could have an inflationary impact. But to this point, they've done a good job of navigating that uncertainty by locking in prices in the first quarter of this year. Another big thing to highlight on what the impact has been and what it could be is when you look at trading partners for the United States, there are three big ones by a mile: China, Canada, and Mexico. Canada and Mexico to this point have largely been exempted by previous relationships that have been now codified by the administration, where they have been able to avoid really the most punitive parts of the tariff side. So two of your three big trading partners are likely not going to be largely punitive from a tariff perspective. China, obviously, those discussions are ongoing. Both administrations have taken a relatively hard line. And you can see the impact on that middle display on the top graph, where Chinese exports to the US and US imports from China have fallen precipitously year over year, down 35 and down 20% respectively. But what you can also see is that some other South Asian countries, notably Vietnam and Thailand, have seen huge increases in both those categories. So one of the things that China has done, and again, the Trump administration has made moves at least to potentially try to cut this off, is move their factories from China to Vietnam, produce the goods there, and export it to the United States via that way. You could think about that as sort of a workaround, but that has largely been evidenced in the trade data as well. So while the China tariffs today seem relatively punitive and you've seen a decrease pretty substantially in what we're exporting and importing to China, you've also seen big increases from these other Southeastern Asian countries, which have helped offset some of that. And again, would be an argument for tariffs not being as inflationary as maybe the market expected 9 months ago. The other big dynamic that we've seen that perhaps is a bit more of a surprise is, to this point, companies have been willing to absorb a fair amount of those incremental costs on their own margins versus passing them through to the end consumer. And companies are able to do that in part because their profit margins, at least from a US large cap perspective, are as high as they've been in 25 years, which is what the right-hand display is showing. So that's the S&P 500, the constituents' profit margins. That gives them a lot of flexibility to absorb some price increases. Yes, it will ultimately lower their margins, but they're not in a position where they have to pass through every single cent of increases to end clients, and in effect are sacrificing some margin to ensure that clients and consumers stay with them, right? And you've seen that general trade play out almost everywhere, where as inflation has remained reasonably sticky, prices are elevated, wages have not kept up in real terms, consumers have become more value seeking. And at this point, companies have been willing to sacrifice some margin to ensure that they're not losing their clients and consumers, because most Americans have proven that they're willing to kind of vote with their feet and will go to a less expensive restaurant chain or a less expensive grocery store because prices have become so elevated. So companies to this point have been willing to absorb some of that without passing it through directly to the end client. And so when you sort of think about this from a scenario perspective, there's basically three high-level ways that this could play out, at least from our point of view, which we display in the middle display. So the first scenario is companies lose the ability or the wherewithal to keep prices stable. They pass on some of those tariff costs to the end consumer. As a result, sales go down and you get broad economic weakness, right? Prices are up, margins are down, consumer spending and consumer consumption is down. The second scenario is prices increase, but you don't see that reduction in demand, which would require then wage growth to pick back up, which we haven't seen a lot of evidence of really in the last 18 months. Most people would argue that at this area or this stage of the economic cycle, having significant real wage growth would be unusual. So this one is your most positive, right? Prices increases, but so do wage, so sales stay stable, but would require probably the most unusual macro dynamic to occur in terms of wages now reaccelerating. And then the third is basically where we've been sort of 3 or 4 months into the experiment is prices stay relatively stable because companies are absorbing the lion's share of the tariffs. As a result, sales and consumption remains reasonably stable, but you do have a margin degradation there. And again, margins are incredibly heavy, particularly in the US. So there's certainly some room to do that. But at some point, that will affect earnings at an aggregate level to US companies if margins are coming down. And so big picture, when we take a step back, if you look at on the right display where we are from an inflationary perspective, which is the black line, again, you've seen that continued normalization into 23, from 23 into now the middle of 25. Unless you believe that inflation is going to be incredibly low moving forward, so sort of that gray line of about 10 basis points month on month, you're likely to be in a regime where you're slightly above the Fed's target. But we don't expect to be materially above the Fed's target. So risk to the upside, again, consistent with what the Fed members are surveying, but you have not seen the severe impact that a lot of economists and market participants were worried about with the tariffs being a once-time sort of shock to inflation. The data doesn't support that for a number of reasons. And so moving from inflation then to growth, to labor. The labor market, generally speaking, is in an area that we would say is basically as close to equilibrium as you'll ever find. And all three of the displays on this page show that and show that in different ways. So the left shows job openings per person and payrolls. You can see basically if those numbers are at that black horizontal line, that means that there's one job opening for one unemployed person, and non-farm payrolls are steady as they go. You've seen, obviously, we had the spike in 22 and 23 with a really hot job market, tons of job openings, tons of hirings, payrolls expanding at a big and frankly unsustainable level. That has normalized and has trended very close to exactly where the Fed would want it. So you have a very in equilibrium labor market in terms of job openings and payrolls. That does eliminate some buffer, right? If you had some weakness here moving forward, you don't have the extreme health of the labor market, but it's no longer an overheated labor market, and it's not one where you're seeing extreme weakness. And the path in which we got there is... Sorry, is there a question? Oh, sorry, thought I heard something on the line. The path in which we got there is exactly how the Fed would want to script it, right? And that's what's displayed on the middle display is we didn't get to this equilibrium by having a ton of job destruction or layoffs. It was simply that hiring started to slow down from its extremely elevated rate. So that yellow line is the hiring rate. That was hugely elevated and sort of peaked 21, 22. That has normalized as layoffs have ping-ponged around to a certain degree, but you haven't had a huge spike in layoffs, which tend to be a predecessor of a real slowdown and weakness on the labor side. So it hasn't been that jobs have been eliminated and people have been laid off in mass. It's that companies have slowed their hiring, which is exactly how the Fed would want its labor market to normalize. And again, you can see that wage growth is decelerating. That's the blue line on the far right. It is still above the rate of inflation, right? So while costs have been elevated pretty significantly post-2020, and it took some time for wages to start to grow along with those increasing costs, the consumer, generally speaking, from a wage perspective, is still running above the rate of inflation and able to sort of withstand some of these price increases. So that's inflation, that's labor. When we move to sort of the third piece of the puzzle from at least the Fed's perspective, we can look at growth, right? And this might be one where from a headline perspective, you could understand advisors, clients being the most concerned because for only the fourth time in the last 10 years, we had a negative GDP print for the first half of a year. But again, there's sort of the high level picture, and then there's one or two steps deeper. When you look at the decomposition of GDP in the first half of the year, on the right hand of this display, you can see a massive negative, which was a huge fall in exports. And just the way that the math works around GDP, we subtract out imports when we're calculating GDP because they weren't produced in the United States. And therefore, from the way that we measure it mechanically, they shouldn't count towards GDP. Obviously, there are the huge part of the economic activity, and there are all the component parts that we then use to create all the things that do flow through to GDP. But you had a massive fall in imports, which posted a big negative impact in Q2 GDP. Obviously, if you remove that or had a more normalized net export picture, GDP would have been positive. So yes, technically a negative print in the first half of the year, almost entirely driven by a huge change in the import-export dynamic, which we've already covered, was largely driven by a lot of activity importing things in the first quarter, and then almost a complete cessation of that activity as market participants and companies and leaders waited to see how the tariff news would actually be implemented and flow through into the real economy. So things that we're keeping an eye on from a growth perspective is, one, consumer spending has been the huge engine of US GDP now for over a decade, right? And so what we're showing on the left is personal spending, which is one of the ways we proxy consumer spending. You had a pretty material slowdown of that as well in the first half of the year. It was the lowest 6-month reading we'd had since COVID. So again, while the growth picture on a headline perspective might look a little scary in the first half, it's explainable. You do see a slowdown in consumer spending, again, as measured by PCE, that's the middle display, as measured by retail sales, that's the right display. All these numbers are positive, by the way. So it isn't that consumers are not spending in aggregate, but when you look at the trend, it's clear that there is some level of cautiousness from consumers that we've seen in the US in the first 8 to 9 months of the year that we hadn't seen in previous years. And again, just given how important spending is for US GDP, that's something that we think bears close monitoring as we move forward. And then the second thing is, what is the sort of, okay, so if consumers are telling us that they're more cautious and slowing down, what's the broad business community telling us? It's something very similar, right? So one of the things that we've talked about and observed a lot is, when you look at PMIs, right, the measure of how much economic activity is happening in the United States, the two core components of that of services and manufacturing. Services have really been the standout winner, particularly post-COVID, where manufacturing has lagged. The blue line is services. You've seen that is now getting closer to that 50 level, where above 50 is expansionary, below 50 is contractionary. So we have seen services from a business perspective also start to fall. New orders, again, displayed in the middle term. So how much new activity is happening from an order perspective for service providers and manufacturers, that has also slowed. And then small businesses, which are a huge part of the economic activity in this country, you've also seen some concern there. But again, none of these numbers are flashing negative or have moved into real contractionary territory. But when you look at both the consumer and the business perspective, the trend is certainly one of caution, right? Where there is some concern around the level of growth, what the consumer is going to be able to continue to spend. And as a result of largely some tariff uncertainty, but also that consumer weakness, businesses have also taken a bit more of a cautious tone. But when I sort of summarize those three big ideas, right, it's fairly consistent with what the Fed has seen. Inflation has been well behaved and normalizing. To this point, the market has digested tariffs quite well. There is some question on if that can exist in perpetuity, but to this point, no massive evidence that you've seen a spike in goods inflation. And as shelter continues to normalize, while we might not get below 2% in the near future, we don't see huge risk of runaway or material inflation from here moving forward. Labor, again, has normalized, is very close to equilibrium. that has removed some of the buffer there for material weakness. But again, a full unemployment picture and one in which the Fed is largely comfortable with. And then growth, again, absent a headline number that is skewed by some of that import-export dynamic and just the way that flows through to the math, a positive but slowing backdrop, right? So when you look at sort of the high level, it puts, the question is to the Fed of where do they go from here, given all those different macro things that they're watching all the time.
Yeah, Mark, I think that's really interesting there, right? Because when it comes to, and I'll let you take a breath there and have a glass of water if you have one there, right? Appreciate all that information there. But, you talked about three main concepts, right? Inflation, labor, and growth, right? And when we're in these client reviews or talking to 401k participants or whatever it may be about what's to come, right? I mean, we've been saying that those are the main topics that we're focusing on, right? And the big reason why is because obviously that's giving the direction for the Fed, right? And I think it's funny that, we're sitting here talking today because if we go back 12 months ago, right? I mean, again, when we're thinking about how the Fed has dropped rates and whatnot, we had that kind of, first cut in a long time, right? In September of 2024, right? So, again, I just think it's funny how these kind of cycles, come back around and whatnot. And, again, I think that you're kind of teeing this up, right? To kind of talk about, what's going to happen maybe as we kind of get through this data. But I mean, really the thing that we've been talking about with clients is the Fed, right? Their directive, their motive. I mean, what are they going to do? So the main question that, I'm sure that you're getting asked a lot, and I'll tell you that we're getting asked a lot is, how important is the Fed going to be moving forward, right? And not necessarily from an autonomy standpoint or, whatever, but the impact that them, potentially continuing to decrease rates and what that has on the capital markets inside of itself.
Yeah, I mean, look, I think I've probably talked about tariffs and the Fed more this year in my career than I did the previous 10 combined.
Yeah.
But to your point, it's a huge component of where we think that asset prices and what the winners and losers are going to be moving forward is going to be the action that the Fed takes. And one thing that we always try to remind people is, the Fed is full of very smart people whose job it is to predict these things. But if you look on the left table, right, we're just showing what the Fed believed year-end 2025 inflation, GDP, and unemployment would be pre-election day, before Liberation Day, and today. And you can see the direction of travel there, right? Inflation, they thought would be lower than they're projecting it to be as we stand here today. Real GDP, they thought would be a little bit higher. And unemployment, they were pretty accurate in terms of their expectations. So slightly higher inflation, slightly lower growth. That's created this a little bit balancing act and sort of these two opposing forces that up until last week had put the Fed on hold, where at one point it's hard to argue that growth isn't slowing. The Fed has said that the rates are restrictive at the current level, but at the same time, inflation is not at 2%, which is the Fed's mandate. But I think part of the reason why the Fed was comfortable ultimately cutting last week is, A, you had seen some additional labor market weakening, normalization, et cetera. And two, when the Fed, which they do, looks at the various components of inflation, the big argument the Fed was making in terms of why they had to wait to cut was they were unsure on what the tariff impact would ultimately be. Even though inflation is higher than they want it, it's hard to argue that the tariffs are the reason for that, right? So ultimately, that's what won out in that decision making. You can see on the right, to your point, right, the market has consistently priced lower rates moving forward. We're slightly lower than the market is priced as of today. And the market has moved down post the rate cut of last week. And so, the Fed, a lot of times when clients want to talk about the Fed, the next thing they want to talk about is 10-year rates, right? And the relationship that those two have and what the 10-year is going to do moving forward. There's a ton of real economic activity that's tied to the 10-year, whether it's mortgages, borrowing, high yield, et cetera. And we talked about it at the start of the call. You've seen tremendous volatility in U.S. Treasury markets, more so than anybody's career who started after the financial crisis, right? So we're showing just the 10-year on the left display here for the last 2 years. And you can just see kind of the wild oscillations we've had in the 10-year Treasury, which is pretty unusual. And really the interesting thing about it is it really moved from sort of the 22 recession fear trade which we'd argue was sort of driven by fundamentals broadly. And those fundamentals played out in 23 and 24. And will there be a recession? And when will the Fed cut rates? And then it moved a little bit more to the technical stuff, right? So you can see, at the time the victory odds for Kamala Harris peaked, the market really rallied from a 10-year perspective, right? Dropping all the way down to 3.6, 3.7. And then as soon as it was clear or the odds of a Trump victory became more likely, the rates rose again. And now we're in a little bit of a place where we would argue post-Liberation Day, the fundamentals are starting to matter again. But the technicals are still there and always will be there. And one question that we do get a lot of is, there are some of these technical or macro drivers and even, non-market related ideas that could have an impact on the 10-year treasury. And we've listed some of those on the right? So one you get a lot of is, are foreign actors, governments, corporations, et cetera, still buying treasuries to the degree that they were, right? There was a fair amount of news flow, particularly in the first half of this year, about China and other companies dumping their treasury exposures. The data just frankly doesn't support that, right? So you still see a very robust market in the US and outside the US for every single one of the treasury auctions we've had for the last year. But you've also seen that, inflation proved to be sticky, right? And that's going to have impact on bond yields. Equities have continued to rally in a big way, right? That has an impact on the demand for fixed income, broadly speaking. Valuations are currently pretty high, hard to argue on the equity side. So will that have an impact in terms of people coming back into fixed income? There's been this ongoing question of the Fed independence and the current administration's comments about Fed independence and what the Fed is doing, what the Fed should be doing. If that gets called into question, obviously that could have an impact on the 10-year. And then the other one people raise quite a bit is we're now running at very, very high debt to GDP ratios. At some point, does that become unsustainable? Clearly, it's not a healthy sort of debt level for the economy, broadly speaking, but it isn't unheard of, right? There are other developed countries in the world, Japan being the most extreme example, that have run at very high debt levels for very high amounts of time, and you haven't had a breakdown in the functioning of their debt market, right? As long as people are still willing to buy the debt, and as long as you can continue to service it, you should be able to maintain relatively high debt levels. So what do we believe from a 10-year perspective, right? That tends to be what people actually care about, not all this market dynamic, Fed independent stuff. Just tell me where the 10-year is going to be. You can see, right, when you think about the 10-year nominal yield, that is composed of two different things, right? It's the current real yield, which is measured by the TIPS market, you can see on the left, and then whatever the inflation expectations for the market is, you add those two numbers together, that's your nominal 10-year yield. We see in 2025 ending right around 4%. I think we're about 4.15 as of this morning. So trending in that direction, particularly if we have another rate cut or two this year, and then moving down to 375 at the end of 2026. Those are both driven by falls in real yields, right? So we don't expect the 10-year to really fall because inflation really starts to bottom out. We have that fairly consistent at 2.25 for both of the next end of the year periods, but we do think that you're going to continue to see real yields fall, which should be supportive, broadly speaking, of U.S. bond investors. One other thing that we do quite a bit within our multi-asset team, and we get asked about quite a bit, is, how are you guys seeing the relative attractiveness of a number of different macro assets? This is our quantitative point of view. So this isn't an end-all be-all for us, but I do think it's a helpful way to pretty simply say, here's where we see the attractiveness of a lot of the big asset classes that our clients tend to ask us about or traffic in. And what you can see is that we're relatively neutral but slightly constructive on U.S. equities, bullish on international and EM, modestly underweight on U.S. fixed income, more underweight on non-U.S., overweight high yield, and favoring non-dollar currencies versus the dollar. So just from a snapshot perspective of what our quant tools are telling us, they're saying be overweight equities, be modestly underweight fixed income, and be overweight high yield. And when we move to the equity piece, right, there's a couple things that we're keeping an eye on, particularly on the US side. One is earnings revisions, right? So companies revise their earnings all the time. One of the things that we like to pay attention to is the direction of travel of those revisions, right? If our company's coming back and revising earnings up or down, while aggregate earnings, so if you just think about the level of earnings, have been very strong, the trend from a revisions perspective has gotten lower and lower as the year has gone on. So put another way, companies are still very robust from an earnings perspective, but have gotten, again, more cautious as the year has gone on in terms of their ability to continue to maintain this high level of earnings. And part of that is driven by the sector dynamics that we've seen that have been obviously hugely impactful of asset class returns, but are also a big part of where you're likely to see winners and losers moving forward. So when you look at the earnings revisions by sector, you basically have three sectors that are generating all the positive revisions: communications, financials, and tech. Again, perhaps unsurprisingly, financials tend to benefit from falling rates. Obviously, everyone's aware of the tech story in the United States and AI, and all that flows through into here. But those are also some of the sectors that tend to be very trade heavy from an international perspective. So particularly communications and tech tend to have a lot of non-US revenue. That's the right display. So again, something to keep an eye on as these tariff and trade discussions unfold is some of the strongest sectors from an earnings perspective also make a lot of money from outside the United States. So being selective is key when you're thinking about where you're taking your equity exposure. And that also was really on display when you kind of had the tale of two quarters in the first half of the year, right? Where in the first quarter, you had, Russell 1000 growth do great, Russell 2000 do great, S&P does great. Excuse me, I've got that backwards. So in the first quarter on the left display, right, the blue bars represent the first quarter performance relative to the return, and then the yellow bars represent the second quarter. And what you can see is a pretty clear risk off, risk on dynamic, right? Where in the first quarter of the year, growth is down, large cap XMAG 7 is flat, S&P is down, and then when you get the Liberation Day and then the clarity thereafter, you had a huge rally, particularly in those places that had been hurt the most, right? So growth rips, large cap XMAG 7 rips, etc. Low vol continues to do well, EFA continues to do well, EM as well, but you did, particularly in the US, have a pretty distinct leadership shift of sort of the high growth, high flying names that had really been under pressure in the first quarter, then really rallying hard on the news that some of these tariff worries were getting worked out or at least paused. Concentration remains a major thing to think about, particularly as clients invest more and more to passive indices, right? We're at really historic levels of concentration. That's the middle display. So this is just the 10 largest names in the S&P 500. You can see we haven't been this concentrated from an index perspective in 40 years. And again, you saw that dynamic play out in the first half of this year, which again, we think is a little bit of a precursor of things to come where selectivity fundamentals might matter more than they had in sort of some of this just tech exuberance that we had in 23 and 24, which is the right display, right? This is the Mag 7 versus the market. 23, 24, all of them beat the market. Some of them, 3 or 4 times the market as, again, this sort of exuberance, AI, the spending related to it, really drove these winners in a meteoric way through the market. In the first quarter, only one of them outperformed the market. That was Meta. And now in the 2Q, again, as you've had a little bit of a relaxing, they've all done well. But to us, the first quarter was a pretty clear signal that if you start to get a slowdown, if you start to get some real uncertainty on the macro picture, don't just assume that the Mag 7 is going to bail the market and the S&P 500 out. Being thoughtful and having a real thesis and a point of view around the winners and losers here at some point will matter when you don't have this sort of incredible groundswell behind you, which, by the way, when you look at...
Mark, really
So, go ahead.
Sorry, I don't mean To jump in on you there, but it's a really good point and something that we've been talking about with a lot of clients, right? Is that diversification itself, right? If you think about how the market has trended over really kind of the last 5-7 years, it's been those max sevens, right? Everybody knows that from a technology standpoint, but again, this year I think it's been a good testament, right, of one, the volatility there, but also asset classes, right, that people weren't thinking of or using in the past that they could be viable if this type of volatility persists, right? So, I really wanted to highlight that from the standpoint of, again, that volatility, but also the information that you're providing, right? Is again, is diversification finally back from the use of, small caps, international stocks, bonds, I mean, you name it, even alternative investments, right? That's been obviously a hot topic here recently. So again, just really wanted to highlight that information there. And I think it goes to prove the point that, maybe moving forward, right, it may be a little bit more challenging, right? And the things that worked in the past may not be the things that work into the future.
That's a perfect segue, Russell. It's like we've been rehearsing this for weeks because that's exactly, I think, the salient point and the real takeaway. And, one of the things that I find a little sobering as someone who works in the industry is when you look at the peers of AllianceBernstein, and AllianceBernstein itself, by the way, every single large asset manager has a point of view for a long period of time what they think various asset classes are going to do from both a return and a risk perspective. AB is no different. On the left hand of this page, we're displaying the 10-year forecasted returns for US large caps of some of the largest asset managers in the world. And the average of that group of people who get paid to generate returns for their clients and frankly probably have a bias to want equities to do better than worse is 5.5%, right? So we've annualized at a number that's almost twice that for the last 10 years. And again, people have been saying for 18 months or 2 months that the equity market's very expensive. It can't continue to do that. I can't tell you exactly when US large caps stop being the dominant asset class that they've been for the last 5 years. But history would suggest that a lot of the smartest investors in the world are saying you shouldn't expect to get 10 or 11% from your S&P 500 performance for the next 10 years. It'll probably be more like 5 or 6%. So in that backdrop, right, everything that you just said, Russell, becomes very important, right? So how diversified are you? What asset classes are you utilizing? Are you building a portfolio that can still deliver the absolute level of return you want if you don't get sort of the get out of jail free card of just massive US large cap outperformance, right? And when you think about US large caps, right, there's admittedly, right, there's arguments kind of pro and con. We're describing them here as vegetables and dessert, right? We've got obviously tariff rates where we can debate their impact on inflation. We can impact the degree that companies will pass them to end clients. We can debate if it's a one-time shock or an ongoing sort of lowering of economic activity. But you're hard pressed to find any market participant who doesn't think that tariffs will reduce economic growth in some way, shape, or form, right? So we're in a tariff rate that we haven't had in almost 100 years. That's just the fact of the matter. You've got fiscal policy that's obviously pretty uncertainty. You've got immigration and what the impact that will be on labor markets, what the impacts that will be on inflation and wages. So you've got some real questions to ask yourself about US large cap performance. And then on the flip side of that coin, right, we've got tax cuts and deductions that have been extended via the Trump administration, a deregulation push that should be market friendly, again, spearheaded by the Trump administration, and then an AI boom, which, ask 10 people whether it's a bubble and whether it's structural and whether it's overbought or oversold, you'll get 10 different answers. But there is at least an idea that this is, the secular kind of capital expenditure period of our careers, and that could just persist. And all the investments that are in the news every day, will they be the dollars that people are throwing around? Who knows? Probably not. But it is going to be a material point of investment and focus for the market moving forward, where the U.S. has, at least to this point, established itself as a clear winner. So pros and cons, but most market participants and most asset managers would tell you that you're likely not going to replicate the last 5 years of U.S. large cap performance for the next 5 years. And I don't think that's a particularly controversial opinion. So when we look and we sort of then say, okay, if I'm in a backdrop where U.S. large cap performance may not be as broad-based and as strongly positive, again, being selective and being diversified in your approach becomes even more popular. and we talked about it a little bit on a previous slide, right? The first quarter, second quarter dynamic was a really interesting kind of 6-month case study in what this might look like if market exuberance wanes, and then what it looks like when market exuberance comes back. And again, what you're seeing in the left display is in the blue lines, where a lot of what we would call your lower quality metrics, right? Your higher beta names, your names with the higher book yields with a lot of sales variance, had a really tough Q1 as that exuberance fell, and then rallied back, broadly speaking, in Q2. And a lot of the higher quality, the opposite happened, with the notable exception of your earnings revision ratio, right? So we've talked about earnings revision a couple times in this presentation, but managers that focus and were able to identify companies that continue to have strong earnings and strong earnings revisions were winners in both cohorts, right? And when you look at the longer term trend on the right display, those metrics that we would call more quality metrics, right? Higher return on invested capital, higher free cash flow, higher EPS revisions have been your consistent winners. There have certainly been times where lower quality people have had pops and have big market performance. The last 4 to 5 months is a perfect example, but some of those more high quality, more we would call judicious companies have been able to prove over the last 3 or 4 years that they're able to generate performance regardless of the macro backdrop. And so when we move to fixed income, right, again, I find it particularly helpful sometimes to overlay how the market has moved in just the last 18 months in fixed income land, right, which is what we're showing on the left-hand side. So this is just a US Treasury curve. And what you can see is while the short end of the curve has remained very stubborn, right? And that's the part of the curve that the Fed has the most direct control over via the repo rate. As the Fed has been on hold and high, the short part of the yield curve really hasn't budged very much. But the sort of what we would call, and most people call the belly of the curve, you actually have had a lot of movement and have had a pretty dramatic fall in rates, where 5-year bonds have fallen from 4.4 to almost 3.6, 3.7 over the last 16 to 18 months. That's where, when we mentioned earlier, when you look from a sort of big picture perspective at US government bonds, the performance has been fairly underwhelming. There have been parts of the yield curve in particular where you've been able to generate some performance as rates have come down. That long end of the curve, again, has stayed pretty stubborn. That's a function of US debt levels, the market basically saying that they need a massive premium for that length of time because there are now real questions about what the US balance sheet is going to look like in 30 years. And if you're asking an investor to go in and buy a 30-year bond, the market's saying, I need a pretty big premium to lock up my money for that amount of time. Again, we've talked about high yield and how steady it's been. Credit spreads are basically right around 2Q25 levels, right, in terms of the average. So you saw a little bit of a flare during Liberation Day and that April-May period, but nothing material, nothing consistent with a real re-rating of the debt or real concerns, largely just the macro noise. But credit and IG continues to be very well behaved. We covered this briefly on a previous slide, but one question we do get quite a bit is, are you seeing a slowdown in the appetite for people to buy treasuries given the amount of debt and the current budget deficit that the US is running? And again, the short answer is no. So you can see on the left-hand side, this is just basically a bid to ask spread for treasuries. When that widens out, right, it means that buyers and sellers are at very different places in terms of where the bonds should be priced and sold. That's been right dead on average for the last 10 years or so. You haven't seen a material dislocation there since the financial crisis. Foreign purchasing remains above average for the trailing 3-month period. That's what the middle display is showing. And then frankly, it's kind of hard sometimes to really extrapolate, but just the size and scale of the US Treasury market is so large, to actually displace that as the reserve bond of the world would require years and years of outflows that we haven't even seen start to begin yet. So from just a foreign demand and a demand supply perspective, no real weakening in the U.S. Treasury market yet, which again, we think should be a positive for bond participants broadly. Another area we talked quite a bit about, given the clients that you all work with, is municipal versus Treasury performance. I think most people are aware that municipals have really struggled, generally speaking, year to date. You can see on the left, while U.S. Treasuries have broadly fallen year to date, municipal bonds have actually stepped up to a certain amount. That is largely a result of technical dynamics within the municipal market. Right. So one thing to remember is that the municipal market is extremely small compared to the taxable fixed income market, right? It is a little bit of a niche market. And even with that huge size differential, there's been a tremendous amount of issuance on the municipal side over the last 2 to 3 years. And that has largely been driven in the 2025 and 2024 period for some policy uncertainty, right? So in the first half of the year, particularly in the first quarter, there was some question, there was some legislation that was being floated in Washington about reducing or eliminating the tax benefit of municipal bonds. As a result, a lot of municipal participants said, we got to issue bonds, right? It's pretty analogous to the tariff issue. We think that this might go away. We think this might be more difficult. Now is the time. So you had a huge front loading of issuance, which tends to obviously reduce demand, reduce prices. And you've seen that year to date. But that has resulted in a period where any way you slice it, the municipal bond curve looks really attractive today. So whether it's on an absolute yield perspective, so we show the taxable equivalent yield, assuming you pay a 40% tax rate, is approaching 7% for high-rated municipal bonds. Again, you can see it hasn't been that high in over a decade. So in terms of an entry point, the yield you're earning today is incredibly compelling. The other thing that we look at is the shape of the various yield curves. So when you look at the municipal yield curve versus the Treasury yield curve, the municipal yield curve is significantly steeper. That's important for municipal participants because it basically means as you roll down that yield curve, you'll earn more and more money, even if the market doesn't do anything, versus a flatter yield curve. So that tends to be a very healthy dynamic for municipal bond. And then when you look at the spreads between AAA munis and treasuries on an after-tax perspective, we're showing, end of last year, middle of the year, and then the 5-year average. When you look at, the 5-year, it's almost twice the spread you normally get. The 10-year, similar story, as is the 15-year. So huge relative value opportunities for municipal holders. It hasn't been a fun performance dynamic in munis really for 2 years or so now, but the backdrop in the municipal market today is really attractive, and the performance is really largely been driven by that huge increase in supply, as opposed to some material weakness that we're seeing in the balance sheets of municipals, and that there could be some concern about their ability to make payments. It's a very healthy market today that looks really attractive for entrants based on a return and a yield perspective. So, Russell, I think that was all I had prepared. I will pause there.
Yeah, no, well, I appreciate it, Mark. And I found the information extremely useful. And again, especially with the times that, we've been throughout this year and maybe what's to come, right? So I want to thank you for your time. I think you're tuning in from Nashville, correct?
That's correct.
All right, very good. Well, I know it's a good time down in Nashville if you're a Vanderbilt fan, right? I mean, what a story that's been and whatnot. And with that, obviously, in football season and fall time, we're all looking forward to that here in Richmond, Virginia. I do know that. But Mark, thank you very much, like I said, for joining us. And I also want to thank everybody that's tuned in for our quarterly market review, because without you guys and the trust that you put into us here at Hermitage, we wouldn't have the ability to do the job and obviously be that trusted advisor for you. So that's why we like to bring on partners like Mark to, give you all the ability to, see and talk to the people that we're talking to help us make informed decisions. But again, at the end of the day, we like to thank y'all for the trust that you put into us. That is all we're going to have for today. Mark, thank you very much again. And I hope everyone has a great rest of September, and hope everyone has a great Q4.